Intel's second quarter is one of those reports that is very easy to read the wrong way. If you only look at the headline loss, it looks like a disaster. Intel reported a GAAP net loss of about $11 billion. That is the number most people will remember. But that number does not describe the operating business by itself. Revenue was $16.1 billion, up 25% from a year ago. Operating income was positive. The huge net loss was mainly pushed by interest and other items, including accounting tied to the government equity agreement and escrowed shares. So the useful question is not, did Intel collapse this quarter? It did not. The useful question is whether the expensive turnaround is beginning to produce real business evidence. The strongest evidence is in data center and artificial intelligence. Data center and AI revenue was about $6.3 billion, up 59% year over year. Operating profit in that segment was about $2.5 billion, close to a 40% margin. That matters because AI infrastructure is not only graphics processors. Data centers still need general-purpose processors, networking, memory support, advanced packaging, and systems integration. Intel is not the center of the AI trade, but it is no longer outside the conversation. The client business also looks steadier than many people expected. Client revenue was about $8.9 billion, up 13%. AI personal computers, edge devices, and physical AI give the old PC franchise a new demand story. That is not explosive growth, but it says the base business is not broken. The harder part is Foundry. On the surface, Intel Foundry reported about $5.8 billion of revenue, up 31%, but most of that is internal revenue. External revenue was only about $293 million. The operating loss was still about $2.1 billion. That split is important. Intel can say Foundry activity is growing, and that is true, but outside customers have not yet validated Intel Foundry at scale. Internal work can keep the machine moving. External orders are what prove the model. On technology, there is real progress. Management said 18A output was about 25% above its target and more than 50% higher than the prior quarter. The 18AP risk production path is moving, and the 14A process design kit is targeted for version 0.9 in October. That is encouraging, but process progress is not the same as commercial proof. A factory can improve yield before the market has fully decided to trust it. That is why the capital spending discussion matters. Analysts asked whether higher capital spending means Intel already has major external foundry orders. Management's answer was careful. The spending covers servers, client products, advanced packaging, substrates, clean rooms, equipment, and future capacity. In plain English, not every dollar of capital spending maps to one external customer order. This is the central tension in Intel now. If demand is weak, the turnaround fails. If demand is strong, the company has to spend even more money before it can collect the reward. Cash and short-term investments were about $29.7 billion. Total debt was about $50.5 billion. Capital spending for 2026 is expected to be more than $20 billion, and management already suggested that 2027 spending could be meaningfully higher than 2026. That is why this is not a light recovery story. This is a heavy capital revival story. Intel is trying to rebuild technology leadership, manufacturing credibility, and AI infrastructure relevance at the same time. There is also a smaller but interesting growth line in custom silicon. Management said the ASIC business is approaching a roughly $2 billion annualized run rate with a target of around $4 billion in the not-too-distant future. That business combines processor intellectual property, design services, packaging, and manufacturing capability. If it works, Intel gets a broader platform story. If it does not, it remains a promising sideline. So the conclusion is balanced, but not vague. Intel's second quarter was not a clean turnaround. The foundry business is still losing money. External foundry revenue is still tiny, and the balance sheet has to carry a very expensive investment cycle. But it was also not a collapse. The operating business improved. The data center segment was strong. the client business held up, process execution showed progress, and the company is getting pulled back into AI infrastructure demand. The 4 things to watch next are simple. First, whether data center and AI can keep growing without margin pressure. Second, whether 18A and the next process nodes keep improving in yield and cost. Third, whether external Foundry revenue moves from symbolic to material. Fourth, whether capital spending can eventually turn into free cash flow. Intel is back at the table, but this is an expensive table, and the bill arrives before the payoff.